What if money could start paying you every month, even while you sleep? Money bag. Many investors in the United States earn hundreds or even thousands of dollars in passive income from stocks without working extra hours. Show animation of stock chart rising and cash flowing into a bank account. Passive income from stocks is one of the most powerful ways to build long-term wealth. Instead of trading constantly or watching the market every day, investors can earn income through dividends, long-term growth, and smart investing strategies. In this video, you'll learn how passive income from stocks really works, the strategies investors use, and how beginners can start building a steady stream of income from the stock market. Stay until the end to discover simple tips that can increase stock income faster. Show growing investment portfolio dashboard. Section 1. Understand dividend stocks. One of the most common ways to earn passive income from stocks is through dividend-paying companies. Dividends are payments that companies distribute to shareholders from their profits. Show animation of company paying dividends to investors. Many large companies pay dividends regularly, often every 3 months. For example, if a company pays $1 dividend per share, owning 100 shares could generate $100 in passive income. Over time, as investors own more shares, the dividend payments increase. Show cash payments appearing on screen. Section 2. Look for high-quality dividend companies. Not all dividend stocks are equal. Some companies consistently increase their dividends year after year. These businesses are often stable, profitable, and well-established. Show large stable company buildings and steady growth charts. Examples often come from industries like consumer goods, utilities, healthcare, financial services. Companies with long histories of increasing dividends are sometimes called dividend growth companies. These companies can create reliable passive income over time. Section 3. Use dividend reinvestment. One powerful strategy is reinvesting dividends. Instead of withdrawing the dividend payments, investors can use them to buy more shares. Show animation of dividends automatically buying more stock. This creates a compounding effect. More shares generate more dividends, which buy even more shares. Over time, this snowball effect can significantly increase passive income. Show investment snowball growing larger. Section 4. Invest consistently. Passive income from stocks grows faster when investments are made regularly. Instead of waiting for perfect market timing, many investors contribute money monthly or quarterly. Show calendar with monthly investments. Even small investments like $100 or $200 per month can grow significantly over several years. Consistency often matters more than timing the market. Show steady upward growth chart. Section 5. Diversify your stock portfolio. Putting all money into one company can be risky. A diversified portfolio spreads investments across multiple companies and industries. Show portfolio pie chart diversification. This reduces risk and stabilizes passive income. For example, owning 10 to 20 dividend-paying stocks across different sectors can create more reliable income streams. Section 6. Consider dividend ETFs. For beginners, selecting individual stocks can feel overwhelming. Dividend exchange-traded funds, also known as ETFs, offer a simpler approach. Show basket of multiple stocks inside ETF. ETFs hold dozens or even hundreds of dividend-paying companies in a single investment. This provides instant diversification and stable income potential. Many long-term investors use dividend ETFs to build passive income steadily. Section 7. Focus on long-term growth. Passive income from stocks rarely happens overnight. It grows through patience and consistent investing. Show long-term investment timeline. Over years, dividends can increase as companies grow and raise payouts. Investors who stay invested for 5, 10, or 20 years often see the biggest results. Time in the market is usually more powerful than trying to predict short-term movements. Section 8. Avoid common beginner mistakes. Many new investors chase extremely high dividend yields. However, unusually high yields can sometimes signal financial problems within a company. Show warning icon near unstable stock chart. Instead of focusing only on yield, look for companies with stable earnings, consistent dividend history, strong financial performance. This approach protects long-term income stability. Bonus tips. Tip 1. Start as early as possible. Time allows dividends and investments to compound faster. Show compounding graph accelerating. Tip 2. Increase investments gradually. Even small increases in monthly investing can significantly grow passive income over time. Tip 3. Stay patient during market volatility. Stock prices may fluctuate, but long-term dividend income can continue growing. Show market dips but long-term chart rising. Passive income from stocks is not about getting rich quickly. It's about building a reliable income stream that grows year after year. Another important factor in building passive income from stocks is understanding dividend yield. Show stock dashboard highlighting dividend yield. Dividend yield shows how much income a stock pays compared to its price. For example, if a stock costs $100 and pays $4 per year in dividends, the dividend yield is 4%. This means every $1,000 invested could generate about $40 annually in passive income. But remember, yield should not be the only factor when choosing stocks. A balanced approach between yield, company stability, and long-term growth is usually more effective. Another strategy many investors use is creating a dividend income portfolio. Show portfolio dashboard with multiple dividend payments. Instead of relying on one stock, investors hold multiple dividend-paying companies. Each company pays dividends at different times of the year. This can create regular income throughout the year, almost like receiving multiple paychecks. For example, some companies pay in January, April, July, October. Others pay in February, May, August, November. Others pay in March, June, September, December. Show calendar filling with dividend payments. By spreading investments across these schedules, passive income can arrive almost every month. Another powerful approach is focusing on dividend growth. Some companies increase their dividend payments every year. Show yearly dividend bar chart increasing. For example, a company paying $1 per share today might increase it to $1.20 next year, and even more in the future. This means passive income grows without buying additional shares. Over long periods, dividend growth can significantly increase total income. Market fluctuations are also a normal part of investing. Stock prices may rise and fall daily. Show volatile stock chart. However, long-term investors often focus on income and company fundamentals, not short-term price movements. Dividends may continue even when stock prices temporarily decline. This is why many passive income investors stay focused on the long-term strategy rather than daily market noise. Another key concept is building multiple income streams from stocks. Passive income does not have to come from only one method. Investors often combine strategies such as dividend-paying stocks, dividend ETFs, long-term growth stocks, real estate investment trusts, REITs. Show multiple income streams merging into one income flow. This combination helps create a stronger and more reliable passive income portfolio. Over time, as investments grow and dividends compound, passive income can gradually increase. What begins as small dividend payments can grow into a meaningful income stream. Show small coins turning into large stacks of cash. This process takes patience, consistency, and a long-term mindset. But for many investors, stocks eventually become a powerful tool for building passive income and financial independence. As the portfolio continues to grow, the power of compounding income becomes even more visible. Show animation of small dividends turning into large stacks of cash. At first, the dividend payments may seem small, maybe a few dollars per month. But as more shares are purchased and companies continue increasing their payouts, those small payments slowly grow into larger and more consistent income streams. Over several years, this process can transform a simple investment portfolio into a passive income machine. Show long-term portfolio growth chart rising steadily. Many long-term investors eventually reach a point where dividend income can help cover real-life expenses such as utility bills, groceries, rent or mortgage payments, travel and lifestyle costs. At that stage, the stock market is no longer just an investment, it becomes a source of financial stability and freedom. Show peaceful lifestyle seen with growing investment dashboard. The key lesson is simple. Passive income from stocks is built through patience, consistency, and smart investing decisions. It doesn't happen overnight. But with time, disciplined investing, and reinvesting dividends, the results can become powerful. Show final animation of portfolio value rising and dividends flowing in. Small investments today can grow into long-term income tomorrow. And that is how many investors slowly turn the stock market into a reliable source of passive income and long-term wealth.